Welcome to the Money Vikings Podcast, where we conquer financial freedom. Join Greg, Jerry, and Bob as they discuss everything investing and personal finance. The Money Vikings Podcast is hosted by three dads who are doing what they can each day to burn down debt and build wealth. Learn the path to true wealth. Their podcast and website, moneyvikings.com, is a treasure trove of ideas. So without further ado, here they are, the Money Vikings.
Real estate, a source of wealth for Viking kings and queens, and the genomics age of cancer screening. These things have nothing in common, but they will be interesting to explore. The dad jokes and investing ideas will continue on the Money Vikings Podcast, number 51. Bob, Jerry, are you there?
Yes, we are, sir.
Dude, you know, sometimes you just have to have things that do not relate or correlate at all.
A lot of times, Bob, the intros have sort of like some kind of connection that you can sort of, weave together. And I'm just like, okay, I'm like real estate and the genomics age of cancer. I don't know. I guess you need real estate to develop genomics tools.
I don't know.
Yeah, maybe. Yeah, it's a little stretch.
Is there a genomics real estate investment trust that we can throw in here? I don't know.
Nope, but there will be tomorrow. Let's start it.
There probably is one that we could find. Hey, listen, I know you guys are excited about this. Again, Money Vikings Premium has been off to an amazing start. And I just wanted to say thank you so much to all of our premium members. We are working very hard to deliver value. And please reach out to any of us if you need help getting into the Discord chat or with anything. We are here. We're part of the wealth building team. It's gone great and it's going great. Yeah. So again, thanks to Brian, Gator Traders, Penny's crew, Paper Gains, all of our partners. It's just great. We're building this community that is really bringing the best ideas together, and it's holistic, right? We're looking at, we provide options, trade strategies, swing trades, but then there's also, dividend plays, long-term buy and hold that I'm doing a lot of research on, ways we can even improve our health along the way, be more efficient, more frugal. I'm excited about it.
It's cool. I'm loving it. It's been a great engagement so far. I've been able to kind of do kind of one-on-ones with some of the members, and they've been very thankful for it. And we'll say one of them made a comment and it was very truthful, right? And I appreciate and very receptive to this. Is he wasn't sure about us at first because he didn't know if it was some scheme. And after we talked for over an hour. He's like, I can genuinely see that you guys are genuine, and this is to get help, provide help and ideas to people. And it was just. Yeah, I felt
Bobby,
happy about it.
That is wonderful, and this. I mean, everything we're putting out there, they're the things we're doing. I mean, we are doing these things. We are trying these things. We're not selling something that we're not invested in as well. We're like, hey, we're looking over here. We're finding these plays. Yeah. Here's a new portfolio construction that we found that is appropriate for the timing we are in the business cycle and in the market cycle. Yep. And speaking of, what do you guys think about the SPY? So we always start out, we're talking about a little bit about the news. It's been a bumpy September.
I've got the SPY all figured out. Here's all you gotta know.
Already.
Here's all you gotta know. Take a look at the chart of the SPY for the last year or so. Put it up if you are at a computer or a mobile device. Pull it up. Take a look at the daily view and turn on the 50 moving average, EMA or SMA. And you'll see that it has been bouncing off the 50-day every options expiration cycle. So every
15 period or the 50
50 SMA or 50 EMA. Okay. And you'll see that it's been bouncing off of it religiously every time there's options expiration Friday.
Let me see this. Okay. I'm getting my setup here.
And I think as soon as we've got this figured out, it changes. So you can't use it anymore, probably.
Yeah. Thanks for announcing this. Now next week, the market makers.
This is the last week only.
Right. So Jerry, what's the bottom line going forward in your view then over the next few months?
Oh, I have no idea. It's a 50-50 shot. Give me a dartboard. I'll
Okay.
I don't know if we're going up or down. I'm just trying to be cautious. And like Bob's been talking about, I've been adding UVXY when it gets cheaper. Tom Sosnoff kind of likens it to almost whack-a-mole. He waits for the SPY to just go up towards that top of the channel, and then he starts selling calls against it or buying puts to like hit it down and let it deteriorate again, and then he'll repeat the cycle again. He's just waiting for it to rally and then bang on it.
So here's the thing: I'll say is I do like what Jerry was saying about the moving averages on the daily, but however, what happened Friday on the witching kind of changed a little bit because the price dropped below that point.
It did.
And what I had charted out was there is a trend that goes back on the SPX back like 40 years, like 60 years or something like that.
On your video, I saw, yeah.
You saw that, right? And so it is confirmed. I mean, this is something that is pulled from decades ago, and sure enough, what's happening now was confirming it. And historically, when things had dropped below that support point, it continued to drop further. And so that's what has me kind of nervous, or I don't say nervous. I shouldn't say nervous.
Yeah,
because I'm hedged, and
exactly
this is what we talk about. I talk with
you're
all
hedged,
the time about
you're diversified.
hedging. You're managing risk.
Right.
One of the other analogies I've heard on Fast Money, I listened to the chart master Carter Braxton Worth, and he says that these supports are almost like mattresses. So they go in a little bit,
soften down,
and then they could still spring off them. Of course, and it looks like it did that in March as well of this year. It did go below that channel, the 50 moving average.
I think, guys. Oh, sorry, Jerry. Go ahead.
That was it.
Oh, I was just going to say, I think at the end of the day, right, simply what we're trying to do is that where we buy assets, right, and where we enter equities matters. I mean, so we're all trying to sort of figure out, is it time to take a little profits? Is it time to become more defensive?
More liquid, right?
Yeah, or more liquid. Or if I was someone that, all of a sudden, for whatever reason, I mean, maybe there's somebody that sold a house out there and is sitting on, a few $100,000. I don't know if I would want to drop it tomorrow, all into the SPY. I think I would feel like I was paying a pretty high price. Now, if my time, if that person's time horizon was 30 years or 20 years or even 10 years, I wouldn't worry about it. But if you were considering that you were maybe buying assets at that moment in one big chunk, you might be paying a pretty good premium for all that.
Yeah.
So anyway, to me, it looks like a lot of things are fairly valued. You guys know I do a lot of deep dives into real estate investment trusts, dividend aristocrats, et cetera. And I can tell you, from my perspective, it's getting harder and harder to find values out there. It's getting harder to find stuff that is kind of been under the radar or the market hasn't quite appreciated it. I am finding them, though, for our premium members, just so you know. Yeah. I am finding a few that the market hasn't quite understood that they are great companies and they've been doing fine, but they haven't been fully valued yet for what they really can provide.
Yeah, I mean, Greg, I do give you credit for that, and I do. Hats off to you because.
Oh, thank you, sir.
Yeah, thank you, sir. But you really have. Like sorry, I'm gonna toot your horn, but it's like toot away.
Any day.
But the thing is, you do have a skill that not many people have. I don't have it. I like the charting and whatnot, and the opportunities and the kind of day trade, swing trade style. But you do a great job in this market, whether it's a large cap or small cap or an ETF, right? You've been able to find the value and find the opportunities, and even find things that can be a little more resilient to this market with what it does.
Well, I appreciate that. I mean, we all bring a different, we're all bringing a different tool to the battle or to the job, right? Is how I see it. And I think the modern investor has to have a little bit of a jack of all trades view. I mean, listen, for a lot of people, Jerry, we've talked about this before. There's good 3 and 4 fund portfolios that are
Yes.
fine, right?
Yeah.
And that's fine. There's people do it, and if you have no interest in investing and you just never want to think about it one day in your life, do the 4 portfolio,
Absolutely.
Yeah, but if you're interested in it and if you want to have a little more control of your money and you want to actually try to get a little better return, try other strategies. I mean, what's this, Jerry, about? Tell us about this AA investment survey.
AAII is the, I thought it was the AARP, but it's not AARP. It's
Not yet.
Not yet.
Not yet.
But you can
Close.
join AARP. I learned on Twitter this week. You don't have to be 55 or whatever to join it.
Sign up.
Yeah, right.
Gen Xer.
Get your coupons and discounts right away. AAII stands for American Association of Individual Investors. And so we had like a 2% drop this week in SPY. And it just seems that the majority of the investors on this little 2% drop, 39.3% of investors are now bearish on the market.
Mm-hmm.
And 22% are bullish and 38 are neutral. So it's just interesting. And I was listening to a few podcasts, really interesting ones. They always look at these numbers. These are based on surveys. They survey individual investors, retail investors, and just ask them, hey, how are you feeling? And generally, you don't see huge corrections when people are bearish. It's when there's lots of euphoria and people don't expect it. So it's just sort of some food for thought here.
That's really cool, Jerry, because it makes sense. If we're all bearish, we're probably kind of like taking the gas off of the accelerator, a little bit. Right. So we're letting the pressure out of the system. We're not driving assets up really high.
Yeah.
I would say I'm neutral because I read different things. As you guys know, you guys read a lot of financial news. I mean, a lot of financial information. I mean, I just think I'm bullish in some areas and then, sort of like neutral in others and kind of like, yeah, we'll see. I don't know. I mean, on the other hand, guys, we'll talk about this. I've got one little blurb here when I talk about genomics. I mean, there's areas in this economy and in this world that and we've talked about this before, but are ripe for exponential growth. And it's just the confluence of technology and the time in history that we're looking at, that there's some areas I think that are really primed for some growth. I mean, anyway, we'll go into some of them.
And we'll probably touch on this, but I'm thinking small caps. I think honestly we are going to see small caps have their day here pretty soon. I think there will be a pivot out of the large cap because of the volatility and just heavy reliance, I guess, heavy weighing in these large caps in the 500.
Well, they've gotten so big, Bob. Yeah. I mean, how much of everybody's portfolio now is FANG? I mean,
right?
It's just
that's where they talk about the inflation. Inflation has occurred in the market. The market space has been the inflationary product.
Bob, it'd be really great to get your take on like an IWM, because I'm just looking at this and I've heard and kind of looking at the charts for the last year or so on the daily. It's really been stuck in a range between like 230 and 210. Yeah. And it's kind of right in the middle now, which makes me think, maybe an iron condor or a strangle's the way to go. At least, for the next few weeks to months.
Yeah. I'm actually glad you brought this to my attention. It's because very clear. And I will tell you, let me go over to looking at the monthly chart, because I'm looking at the daily. So monthly chart has a lot of volatility. Wow. There's a lot of volatility
coming up, or has happened.
Has happened. Yeah. Doesn't mean it's not done, because it's your kind of typical consolidation period, which you would actually relate to a bull flag. Because the price movement has not been downtrend. It's been sideways. But in that sideways movement, you have a couple of days of down, a couple of days of up. But the reality is, like what Jerry's saying, is like it's this channel, right? So this is actually a very interesting one. Let me pull
Great content for audio listeners.
Right. Right.
Well, let me say this.
If you can see what I'm looking at here,
it's awesome. It's the most amazing thing. Hey, man, SpaceX sent some civilian astronauts up, so that was awesome. Imagine that, and go check out the pictures. They're rad.
Boom. Right.
Let me just say this. Okay, again, you guys know me. I tend to be the Papa Buffett. I mean, you guys are too. But the point being this: everybody keep in mind. You're always wanting to manage risk. You're wanting to strategize and develop a portfolio, change with the times when you have to. But keep in mind this, you're building a portfolio for future income and resiliency. Even when different sectors and the market goes down, there's no reason to freak out. There's no reason to pool all the assets and, oh my God, you're trying to build something that if you're maybe you're part of a FIRE movement, or maybe you're going to retire at a normal, retirement age of 65. But when you reach that point, you want this portfolio of assets to basically provide you a monthly income. You're gonna look at tax strategies. You're gonna draw dividend income, whatever it might be. But again, I just like to tell people that there's no reason to freak out. I have had my portfolio. All of us have. Jerry, Bob, you guys, we've gone through so many things now. We've gone through recessions, housing dumps, 9/11, now this coronavirus pandemic. And here's the deal: every time it comes back. And I've known people that have sold at the wrong time. Okay. Yep. Some crazy thing happens, everything tanks, and they just pull all their money. It's absolutely ludicrous.
I'm glad you said this, because this is something I've been thinking about, and I think this is a perfect time to mention is, Jerry does and we talk about this a lot. Jerry does phenomenal option strategies, and I give full credit to you on those, because you find ways that even in a losing play to try to roll it, right? But we're human too, and you will see that there are times where we have an options play that doesn't go the way we want it. Hey, we're transparent about it, and we'll say, hey, might want to get out, or it's not playing out the way that we expected. Boom. But a lot of times you find a way to pivot shift and make it either a neutral play where you're just break even, or it still becomes profitable. Now, the reason why I think we're seeing so much of that reactiveness, pull your money out and run type thing, is because, back to an old conversation that we've had, is the newer wave of investor, the reactive wave of investor that came out of the pandemic. They're also the options investors, and that's what their reality was, because when you had Wall Street bets and these people showing that they're turning $1,000 into $1 million, whatever, right? Which I think are all photoshopped. But anyways, but still, yep. It's this idea. The only reason the way they did it was buying options and really exposing themselves 100%, and leveraging it, right? They're just leveraging. And so it's like, that's the reality that this new wave is exposed to. It's also the reality of why people want to pull all the money out, because they don't understand the idea of buying and truly, quote unquote, investing for the long haul, and just cost averaging down.
Well, if you're investing, you want to think about it like you're buying that business, right? You're owning, you have an ownership stake in that business. So so we've seen here, Jerry, you put it in here over the last month. So energy has done really well.
Hey, real quick, before we go, because Jerry did ask about IWM. What I do want to say just last little thing on IWM, looking at IWM on a weekly chart, I can see it does have bearish divergence, in the sense that the price is consolidating sideways. However, the sentiment, the RSI, is starting to go down into the bearish zone, below 50 mark of sentiment. It is approaching it. It dipped in for a second and bounced out, but it appears it could be walking back in, because I am seeing a crossover in the stochastic at a low level, wanting to cross back over as a sell signal right when RSI is above the bearish zone. So I don't know. This could be a divergence that's drawn out over the past couple months that could meet its stay here pretty soon.
Okay, so listeners, check out Bob's videos if you want to look at stuff while he talks. Okay. No, actually, your videos are awesome. Actually, they are awesome. So over the last month, it looks like energy's done really well, technology, consumer cyclical, but this changes every month, right?
It does, but I think as investors, we should all be aware of the leading and lagging sectors and just kind of understanding what's going on in our universe. Energy, technology, consumer cyclical, and communication services are kind of the leaders for the last month, and then the worst are basic materials, utilities, industrials, consumer defensive, and it will change, but just be aware. That's all I'm saying.
Because those are, so people know, those are, I like this term, canary in the coal mine. Those are indicators of a market kind of correction or contraction, recession, depression, whatever term.
The consumer defensive, industrials, utilities, and basic materials being in the red.
So we're going to see energy sector being the leader, and then consumer cyclicals, and then one other, and then other stuff will be in the red.
Okay.
I'll also pull up my cheat sheet that so I'll pull that up and see, but I know for a fact energy and consumer cyclical are two of them before you start seeing it.
Okay.
So Jerry, what's this about crypto.com?
I just wanted our listeners to know that on crypto.com, I've been doing this for about 2 or 3 months now. If you have a savings account somewhere and you're getting like 0.2% or something ridiculously low, you can convert it to USDC, which is a stable coin, move it over to crypto.com, and they're offering 6% yield on USDC. So I put about $1,000 in there and I get $1 a month. I mean, $1 a week,
well,
for absolutely nothing. And 6%. Then I use that to invest in other cryptos. Maybe I'll feel like buying some SHIB or some Doge.
Wow.
Yeah.
Hey, 6% is pretty choice right now in this world where you just cannot. Again, hey, listen, if you're really risk averse, I get putting a bunch of money in a savings account, but realize that that's risky as well. That's losing value. That's losing 3% to 4% a year in value.
Exactly.
So you got to be beating inflation, and 6% certainly does that.
Yeah, you have to try. It's not FDIC insured like a savings account is, but check it out. Check it out. Some of the Coinbase is doing this. I think Coinbase is actually getting into trouble for some of this. The SEC is investigating them for their new Lend product.
Oh yes.
But this is an evolving industry, but there are plenty of DeFi based high yield savings that you can find in crypto. But this is a good one I've been using for several months, and I've been happy with it. So I just wanted to put it out there. The referral link to crypto.com is in our show notes at the bottom. I keep it in there each week, so go check it out.
That's awesome. So one of our main topics, guys, I wanted to touch on before we get into real estate is, as you guys know, we do a lot of discussion about genomics and pharmaceuticals and just the future of genomics. And, we're big Cathie ARK fans, so we're looking at ARK Genomics and all the stuff's going on there. But I ran across, they're big on identifying companies that are developing blood tests that detect cancer years in advance of traditional screenings. I mean, this is amazing, and it's a game changer. This was thought to be impossible at one time, but they're finding that if someone has cancer somewhere in their body, that as some of those cancer cells die, the DNA breaks off fragments that get into our bloodstream. And apparently there's instrumentation and there's the ability to screen and to identify those fragments. Why is this important? It's important because cancer is more treatable in early stages. Okay. So if someone gets it in late stages, that's a pretty tough hill to climb. It's not impossible anymore. There are therapies, but there's the chemotherapy, there's immunotherapy. But anyway, if they can get the costs down, and if people, when they do their, annual physical, go out and get, their blood tests and everything. If one of those blood tests could be, maybe starting in their 40s or 50s, it's like, hey, go get your cancer screening as well. They might really be able to nip something in the bud that would have really snuck up on them, when they turn 60 or whatever. So, we are looking, there's products out there, and this has been talked about for a while, but there's Grail, CancerSeek, Panseer, but there's also a ton of, there's a lot of companies to look at that are doing this. And
was Illumina on that list too?
Yeah, Illumina actually bought Grail, is what I understand.
I drive past them on my way to work when I used to have a commute.
Well, there you go. Illumina, an amazing stock, an amazing company, but they've done very well at acquiring companies like this. But Illumina was obviously instrumental in getting the cost of doing our genetic sequencing and getting that cost down. It used to be thought that would, you'd never get that cost below $10,000, which really makes it out of reach for most people. Maybe a few people would get it here and there, but I think it's down to like $400. So it's just amazing. So I don't know. This is an area that I invest in, but I'm also just really excited about it as for humanity. So I wanted to share that. Look at our ARK Genomics. That's my go-to, but there's a lot of great ones. We've put them out there before, and we'll keep analyzing them.
So these are in ARK Genomics right now? There
are companies like this in ARK Genomics that are doing these liquid biopsies, for identifying.
We have an open trade on ARK Genomics right now. We're bullish.
We do. Yep.
And just needed to move a little bit.
Get a little bit more.
There we go. All right, guys. Should I set up the big topic here?
Set it up.
Let's do it.
All right. Bob, real estate. Housing is not going to go down. That's all I have to tell you, brother.
What's the big topic? When we talk about that?
Real estate.
Sorry.
What percentage of your portfolio is real estate?
So I'm glad you asked that, actually. It's actually quite big now, that percentage. And I was actually thinking about that before the show. I'm approaching, if you look at the totality of assets, something like 40% exposure now to real estate, which is really high. And that's a mixture of privately run, investment properties, and then of course a lot of REITs. You guys know I'm Papa B. I like dividends. Okay, I like passive income.
Right.
And so REITs, real estate investment trusts, are classic, and we're going to go into those here. But here's the deal, guys. I do a lot of research into real estate. And at the end of the day, there just is not enough. It's a supply and demand thing. And I'm a simple guy. Remember basic economics 101? There's just not enough supply, And so I'm not even really that, sometimes I have to admit, guys, this stuff kind of makes me a little bit depressed, because I do feel bad for people that are getting priced out of markets, and it's getting very hard out there. Right, in a lot of markets. And there's so many millennials. I guess I haven't realized that millennials make up a huge demographic in the United States anyway. It might be the same in Canada. We have a lot of members from Canada, and I'd have to look more into their real estate market. But the bottom line is, baby boomers and older folks, they're not moving that much. They're staying put. And millennials, need housing, and there just isn't enough of it. So I don't know, real estate is one of those things. It stood the test of time. I think it's an asset class that you should be involved in. I don't think owning and operating your own properties is for everyone, and we'll get into that. But I think for diversification's sake, I think a person for a robust portfolio should have some exposure to real estate. And there's many ways to do it. So here's what I would say for people who are thinking about getting into it. And here's like a checklist. Okay. Now I'm talking beyond REITs here. I'm talking about owning and operating your own, buying a single family home, buying an apartment building, buying a commercial property. Okay.
I'll just say it right out. I'll come out and say it. It's not for me.
Hey, I'd like to hear more of why as we go through this. Really,
because
I want to know why.
I do too, but I will say that, Jerry, I believe in you, and I think you can.
Well,
you're good enough. You're smart enough.
Doggone it, people.
I'm glad he's being honest with himself. Well, right? I mean, I think Jerry's onto something very poignant here, because none of us can do. Even Warren Buffett will say this. there's a lot of areas Warren Buffett does not invest in because he just says he either doesn't understand them or he's not that interested in them.
Right.
So I think all of us, and we've heard this actually as part of our launch. People get into the Discord channels, they get into different aspects of investing, and people I think get overwhelmed, understandably. There's like so much coming at them. And my first word of advice or things I'd say is tune out what you're not interested in. If you really dig like the option strategies, dive into that. It's a great thing to do. It's interesting, it's dynamic. You can find a way. If that's your thing, then I would just say don't worry if you're not into dividends, you're not into real estate. I mean, if you're not into it, do what fits your lifestyle. Some people want to be more hands-on. Some people want to look at a screen all day and watch numbers, but here's the deal. Number one, I would say for real estate, do you have the temperament for it? And what I mean by that is, are you organized enough? Are you somewhat handy? Are you somewhat knowledgeable? And I would say, can you work, or do you want, not can you, people can do a lot of things. Do you want to work with people and contractors to solve problems? Because if you're buying individual real estate, you've got to engage with a lot of people. It's nothing like going on Robinhood and swiping left and picking up a few stocks, okay? You have to deal with banks. You have to deal with people. You have to deal with contracts. You have to deal with applications. It's a lot, okay?
Yeah.
So that's the first thing. And Jerry hates people. So Jerry does not hate people. I mean, Jerry is a really fabulous guy to be around, by the way. So I do not. That is not true.
But you hit the nail on the head. That's why I don't like it. No, it's just for me. It's just not the desire to. I'm not very handy with fixing toilets and things I try to fix, I make worse, and we have to spend thousands of dollars to get them fixed after I try to repair to save money. So it just doesn't seem like a wise direction to go for me when there's perfectly good REITs and Fundrise, which I'm sure you'll talk about, and that's great for me. I'm happy with those.
Well, I'm glad you added that. See, Bob and I grew up with a father that was a contractor and a grandfather who was extremely handy. I'm not that good, admittedly. I can do a little bit, and I actually enjoy it, believe it or not. If people don't realize that I actually enjoy it. But Bob is a friggin' master at building and fixing anything. He is. I'm sorry, Bob, close your ears here. But like, Bob, so that's I want our members to know this, that in the future we're going to have videos of Bob like fixing stuff and teaching you how to do it if you own property, because he is that good. I mean, Bob, I mean it. He can fix anything
with no protective gear whatsoever.
Right.
Yeah. It's fascinating. He's lost a couple fingers. There's like blood spraying everywhere. It's pretty gory.
Missing. I mean, it's just
oh yeah, whatever. You maybe one eye. Come on.
Merely a flesh wound.
But this guy's talented, and you're a woodworker, right, Bob? As well.
Yeah,
there you go.
I do the cabinet making as a hobby, but I that's what surprises people, and I think people don't understand about me is, I have built houses from dirt to finish, and built swimming pools, dug swimming pools. Like I've done it all when it comes to homes and houses, and I get joy out of it.
I'm putting this out there. If you become a Money Vikings premium member and then you get stuck trying to fix a toilet or something, you just need to contact Bob on the Discord.
You really could.
I'm
so down to do it.
He'll probably call you. He'll probably call you back and walk you through it.
I'm down. I'm telling you, we've talked about this before, like a few shows ago, where it's like, eventually, yes, we will get to that point on our site where I'm going to do guides and walkthroughs on how to repair and do things. But even people I want to understand is from the aspect of how there are very simple things out there that homeowners should know how to do and can do, and are kind of told or made to think that they're really hard and expensive to do, and they're not. From one perspective of saving money on being able to repair something yourself, but two, ways that you can increase value of your home in a very simple, cost-effective, cheap, inexpensive way. And that's what I'm excited about too.
Well, there you go. That Bob, that is so great. I mean, you're just talking about if you're just a Money Vikings premium member and you own your own home, these videos could save you money because so it'll be in our real estate section. at some point.
Yeah.
Here's the next thing. Okay. Beyond Bob is great at building everything. And he is. No, you have to ask yourself, and you have to be, to go into private real estate investing, you have to be financially fit. Okay. And here, a couple reasons why. I mean, like all investing, you don't start with, it drives me crazy when people go into investing and they want to start with the most complex form of, let's do, futures, options, derivatives times, I don't know, some crazy thing. It's like, guys, like everything, get fundamentals down. Before you join the Major League Baseball league, you do fundamentals. Okay.
You mean they don't let you hit off the tee?
No, you got to get fundamentals down. Okay. So you got to get your foundation set. You got to get your debt under control. You got to get savings. You got to, got to get your credit in a good place.
Yeah.
And here's the deal. A lot of traditional, very few of us, I mean, maybe there's a couple of our listeners out there, but very few of us can go buy and invest in a piece of property and have all the money in cash. I mean, if you do, that's great. I mean, you're going to get instant cash flow, instant return on your investment. Now you're tying up a lot of capital. Okay.
Yeah.
But typically one of the big things about real estate is that you're leveraging the bank's money. Okay. And let me tell you how powerful this is. Okay. This is going to blow your mind. Are you guys ready?
Yes.
Okay. I've seen this happen. If you buy, I'm going to use simple numbers here. If you buy a $500,000, four unit building or single family home, whatever, what you're doing typically is you're only putting $100,000 down. 100 grand's a lot of money, but you're putting 100,000. You're not spending the whole 500,000. When that property appreciates and 10 years later, it's worth $1 million. Okay. And the whole time you've collected cash flow. Okay. So you've been paid the whole time. Okay. You've put 100,000 in. Your $100,000 investment, see the leverage here? Your $100,000 investment has actually gone up 500,000. You've paid down some of the note. So what you have to look at in the totality of it is in 10 years, you could sell that asset, okay, for $1 million. And you basically made 600,000 plus you got paid the whole time. And your initial investment was 100 grand. So that's a really nice return. So
this is the thing is I want listeners to understand, and this is factual, that the most number of millionaires and billionaires in the world have been made through real estate. Because exactly like what you're talking about, Greg, is that you're getting, you're getting free money. You're getting margin, right? I mean,
leverage.
Bob. It's leverage.
It's leverage is what it is. Yeah, you're leveraging.
You're getting not necessarily free money, right? There's interest to be paid on, but you're getting more firepower to buy a piece of property. And if a market correction does occur in the housing market, then you have to wait a little more time. But if it doesn't happen, as it appreciates, that little slice, that little skin in the game you put in, grows in a god-awful amount compared to like what you could get in the stock market.
So you brought up a good point, Bob. Real estate doesn't go up all the time.
Does it?
Okay. And all of us lived and worked through one of the worst, crashes of real estate that our country had ever seen. I wish at the time we could have bought like 20 houses.
Right.
Because, and actually I've known people that did. Okay. Yeah. I know several people, and this is something I want to talk about with people too. Be prepared for your big opportunities. Okay. Have that cash on the sidelines, because these big opportunities do happen. Pandemics happen, crashes happen. I don't know when the next one for real estate's going to happen. I don't foresee a real estate one happening for a long time. I think because it's harder to get a loan now. And again, like I said, the demographics of real estate are just too powerful. But let me say this. I do see a big red flag for real estate, and it has to do with climate change. Okay. I do think that now long-term investors in real estate have to think about where they're going to be. I'm not talking about what climate change, how it was caused. I'm not talking about that. What I'm telling you is that there's areas of this country that we are seeing that are getting hard hit in weird ways. Okay. There's areas where there's no water. There's areas where there's fire. There's areas where hurricanes are getting more powerful. Okay. There's areas that are at low sea level that are going to flood. Don't invest.
Right.
I mean, this is my mantra. We don't give financial advice, but don't invest in those areas. I would not. Okay.
Right.
Because that is just a reality. You're going to pay more for insurance. And I don't know if your asset's going to appreciate as much. You've got to look at this. And frankly, it's something I'm worried about. I've known people too that have lost properties in fires up in Northern California. So it's just a reality now, guys, that we have to look at when putting our money to work in assets.
Yeah.
Managing risk, right?
It is. And that's, sure. It's a big thing, because this is also kind of part of it. Just using as the example, somebody on the West Coast, just because of there's income. We talk about income disparities between geographical region. So somebody on the West Coast who has high property value, income's maybe a little higher, they sell their property and they take some of that and they could buy 4 or 5 homes in the Midwest or in the South, but to that point, Greg, is like, you do need to think about these things. Are you going to be in a hurricane, zone? Mm-hmm. Are you going to have to deal with blizzards and stuff like that? Earthquakes. We deal with earthquakes and fires on the West Coast. So it's you have to take these things into consideration where you're buying as well. Mm-hmm. Is that also going to impact your profit?
Crunch the numbers and know the risk. I mean, it's the same thing we do with stocks investments. Okay, crunch the numbers, and if the numbers make sense, then that's what it's about. Okay, I'll be quick about this, but you got to keep some things in mind. So when you're getting leverage, you have to get a mortgage, okay, for a rental property. Lenders know that rental properties are a greater risk than primary residences. The reason is simple. All of us would do a lot to keep a roof over our head, right? We will eat top ramen and Twinkies to keep a roof over our head.
Absolutely.
And actually, top ramen and Twinkies sounds pretty good.
Not so bad.
Yeah.
Actually, pretty amazing.
Your health will be trash and you'll feel like crap, but it'll taste good going down. Okay.
Oh yeah.
But anyway, again, just like getting your own primary residence, if you're going out to get a mortgage and a loan for an investment property, you've got to have a high credit score. Okay. So you got to work on pumping that thing up. You've got to have a down payment. And typically with a multi-unit or an investment property, it's at least 25% down. A lot of times when you're buying your own residence, you can get away with 10, 15, 20% down. Because again, the lenders know that you're going to do everything you can to stay in that property and pay the mortgage. But it's a lot easier to walk away from an investment, right?
Mm-hmm.
If you really had to.
Yeah, you're not living there.
So another factor to keep in mind is debt to income ratio. They call it DTI, okay? This measures the percentage of your monthly gross income that goes towards paying off debt. So again, you've got to have this in check. You got to have debt in check no matter what, right? Debt can be a tool if used properly, but if you're drowning in it, you're not going to get a loan. And then the last thing I'll mention is savings and assets. Okay, you've got to have something to back everything up, because again, they're looking at you like a risk, and they're saying, okay, well, what if you have a really bad tenant that drags you through the mud for 7 months and you have to go to court? You're not going to be able to pay that lender back. So they want to know, do you have something to fall back on to pay them?
Right.
So it's typical stuff, guys. It's being in a position of strength, which is what Money Vikings are all about. We're trying to get you all into a position of financial strength. Okay. Mm-hmm. And so you're getting ahead in some way. Yeah. Okay. So here's how I would do it. This is how I do it. I like to do something called lily pad hopper. Okay. And I hope I made this up. I don't know if I did, but anyway, it's basically the concept this. You buy a place. This is what I've done. You buy a place, you live in it for a few years, and then as you outgrow it, or you want to move on to maybe a little nicer place or a place of equal value, you save up, you get yourself strong enough financially, and then you buy another property and you move into that, but then you rent out the old one. Okay.
Yeah.
So you're just renting out the old one. And if somebody can do this a few times, it depends on the market you're in. I mean, some markets, if you're in Los Angeles or New York or Seattle, I mean, it's really hard, okay, to do this because the prices are so high. But in some markets, you can do this 3, 4, 5 times over the course of a 30-year, let's say, career. But by the end of that time, you have 4 or 5 income producing assets, that you can either sell then or live off of the cash flow, et cetera.
Mm-hmm.
So I don't know. That's just something to keep in mind.
Lily padding, huh?
I call it lily pad hopper. I don't know why. Nice. I'm just thinking, I'm thinking, I mean, I'm talking about your little frog. You're leaping from one pad to the next, but you're keeping the other pad and you're letting other frogs use it. They're giving you bugs? I don't know.
Okay. So, hey, I do want to say this. So, going back to the housing market stuff. So if any of you get a chance, you want to check out the National Home Pricing Index. Okay. So I will say that the trajectory of the home price index is even more extreme than what it was at the peak in 2006. So, and not just that, it is almost twice as high. So I know you have to account for inflations and whatnot, but there is some uneasiness when I'm just talking about strictly the Case-Shiller, National Home Price Index. It is very reminiscent of what we saw in 2006. So I know that there are other key factors. We're talking about, people getting loans just because they had a pulse. However, we are now dealing with people who are no longer able to suck off the teat of the government with getting these checks, but also there is a drought of jobs available due to the pandemic, with businesses shutting down that are not coming back. So the workforce now does not have as large of a pool to select from to get a job opportunity. So we will have people who actually cannot collect an income to be able to pay for the house that they're in. So in a way that could replicate what we saw in the housing market.
So Bob, I'm going to blow your mind.
Oh, blow it.
I agree with you. It's a perfect transition to what I think right now is a better way to invest in real estate. I'm going to say it right here because I think you're onto something. It's a very hard time to be a buyer, I think, and an investor in privately owned property because of what you're saying. I mean, unless you're some deep-pocketed person that, just you're sitting on piles of millions and millions of dollars and you just go out and buy buildings, that's one thing. And you know what? They have nothing to worry about and they don't, that's fine. But I think it is a hard time right now because they basically look at something called cap rates. Okay. A cap rate, it's just a fancy term for what your initial yield or return is going to be on that privately owned property that you're buying. And let me just tell you this, they're pretty darn low in most markets. Where you used to sort of get like a 6, 7, 8% initial return. A lot of markets now you're going to see something like 2, which is basically saying prices are very high for what you can rent the property. Now, rents are very high too. So that's kind of another angle here. It's a very dynamic thing. But Bob, you're onto something. It's a little bit of a difficult pill to swallow at the moment. So with that, let's talk about real estate investment trusts. Okay. I love them. I love them. I love them. And Money Vikings Premium members know I do. I go through dozens of these a week and I present the creme de la creme. Okay. Let's talk about what they are. Okay. When you buy a real estate investment trust, you're just buying shares, basically, of a real estate investment trust. Okay. Mm-hmm. And so they trade on the stock exchange, just like any company, just like you would buy a share of Pfizer or Amazon or whatever. Okay. They're traded the same way. You're technically buying units, but that doesn't matter. Just call them shares. Okay. REITs right now offer a higher yield on average compared to S&P 500 stocks. Okay. And what I'm presenting are best in class, and I'm trying to find value for you. But here's what a REIT does. They own a bunch of property. Typically, they have a theme, okay? They'll own healthcare properties. Those Simon Property Group will own malls, okay? Realty Income is going to own every 7-Eleven in the world, okay? Dude, every time you buy a Slurpee, you're going to get a Realty Income dividend. I don't know how I can make wealth building any better for you people, okay? Hot Cheetos and a Slurpee, and you just got rich.
Yeah, your health tanks, but hey.
That's true. I'm sorry. Everything's a balance. Okay, but here's the deal. REITs are set up because I think they were set up in the 60s. They get certain tax advantages by committing and legally having to send 90% of their income back to you as the shareholder, okay, in dividend payments. Some of them that I find really fun and clever actually pay a monthly dividend. And it kind of makes you feel like you're a little landlord. Like, again, every time I go to the 7-Eleven and I get we get Slurpees for the kids and stuff.
They bow to you.
Oh, yeah, dude, I would love it. I would love it.
Yeah.
I just walk out and I'm like, oh yeah, I just dropped $1 here, baby. And guess what? One of those pennies is coming back my way. No. So anyway, but
sorry.
I love it. So here's the deal. Real estate investment trusts, I think, are really the way to go for most people to get exposure to real estate. And Jerry, you do them, right?
Oh yeah. I've got some SPG, and I sell options against them. I've been in a SPG Simon Properties covered call now for several months. So as the stock kind of fluctuates between 100 and 105, or no, it was 130, 135. I'm just collecting
wait, let's
premium
not
and dividends at the same time.
Plus the dividend. Not to pat myself on the back, but I told the Money Vikings people to start buying that at 70. Okay, sorry.
Hey, so Jared, I got to call this out though real quick. You're saying you've been in this play for several months now.
Mm-hmm.
So can you elaborate on that? So does that mean that you have rolled that play, or have you been in the same exact play for that time?
No, I've rolled the play. I do monthly covered calls. So every month or so, I will basically, I'll wait for the call that I sold that'll be out of the money. I'll wait for it to get, $10 or less, or maybe just collect 50% of the premium, and then roll it out and sell the call to close, and then what is it? Buy to close. Yeah, it always gets confusing. Buy to close and then sell to open another month out. So I just did that with SPG not too long ago. I've got I think it's an October 15th call that I'm, just.
And this is just an example of like what I was talking about is you found this in a way, your groove with this one, and you are perpetually rolling out covered calls and collecting premium on this as you go,
and dividends.
Some
double dipping here.
It's crazy.
This is amazing. This is amazing.
It's a method that is just what I explode.
Yeah,
it's proving my point.
It is retirement accounts too, so it's not even taxed.
Bob, I want to take Simon Property Group even further. I'm glad you brought that up as an example and how Jerry's playing it, because let me throw this out there too. And this is another reason why I like real estate and REITs. Okay.
Yeah.
Simon Property Group took a huge dump during the pandemic because they basically operate high-end malls. And guess what everybody said? The mall is dead. No one's going to go to a mall.
No.
We're going to live in a world of pandemics, and no one ever wants to be around another human, blah, 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 blah. That's fine. Okay. I get it. But here's the reality. Okay. And I actually knew this. And this is one of the reasons I took a big bet on Simon Property when they were at their depths and their low. I knew from being in real estate investment and development that real estate can be reimagined. And so I was thinking to myself, okay, worst case scenario, let's say the mall is dead. That's fine. But guess what? Housing isn't dead. And Amazon warehouses aren't dead. What would have stopped them if Armageddon really came? Nothing could have stopped them. Yeah, it would have been a little bit clumsy and it would have been difficult. But they could have turned their malls into Amazon shipping warehouses and made another fortune. Okay. Yeah. That's my point about real estate. It can be reimagined. And so I just think that you're managing risk there with something that is in a way flexible. It's that, and it's also stable. it can be a stable thing. So anyway, we're going to keep giving people best in class that we're investing in. But REITs, I can't say enough about them. So I'll go into one last one, guys, and then we'll go into trades for next week. Fundrise. Okay. This is basically, there's a lot of other options out there, but another way to get exposure to real estate is crowdfunding sites now, like Fundrise. I think there's another one called CrowdStreet. Is that right?
Mm-hmm. There may be. Yeah. I don't remember the exact name. Sounds familiar.
Okay. Yeah. Fundrise has been my experience. And
mine too. I'm in it as well. You turned me on to it.
Yeah. Have you liked it?
I do. Yeah.
Okay. Yeah. And we're not getting.
I see new properties every week and look at them with my wife, and we're like, yeah, we're getting some return. It's growing. It's nice.
Right. It's kind of stable. I've been hitting about 8%.
Okay.
So it's not. I don't know. It's not life changing, but it's fine. To put some money there and to get 8% a year on your money is fine. I mean, that's growth.
Totally.
Yeah. So I don't know. So Fundrise is one. We're not getting paid by Fundrise. They should give us money, but they're not. But we've been using their platform for quite a while, and I have to say it's been really good. One thing that I did want to let our listeners know, they just decreased. So this is one thing I didn't like about Fundrise at the beginning. If you withdrew your money before 5 years, so it was really tied up, there was a penalty, and it was kind of hefty. I want to say it was like 5-6%. It was a pretty hefty penalty they were going to take off the top. But they actually just reduced that to 1%. So basically, if you do want to withdraw your funds within 5 years, they way reduce the penalty. But my thing was, you know what? I'm going to put a little money into that thing, let it ride. It doesn't hurt to get steady 7, 8, 9% a year. So
not at all. That's great.
Yeah. So, hey guys, real estate, has nothing to do with battling cancer, but it's a really cool way to invest, in my opinion. And Money Vikings Premium members will see more and more REIT ideas as the years go by, because I really enjoy it, and there's a lot of really neat options out there.
And you know what?
Store, etc.
This is what else they're going to learn, because Jerry just actually hinted to it that I don't think you caught. Is he mentioned something about how he's not getting taxed on some of his stuff because it's out of his retirement account. So these are other things that we're going to be also teaching the premium members about, is how to avoid some of the cap gains taxes out there and really kind of retain a lot of their money. So put that up.
Yeah.
Jerry, take us away on opportunities next week.
Yeah, so for next week, we've got a lot of earnings. I'm just going to go lightning round style through this list. We've got Lennar, AutoZone, FedEx, Stitch Fix, Adobe, Aurora Cannabis, General Mills, BlackBerry, KB Home, Darden, Rite Aid, Accenture, Costco, Nike, and Trip.com.
Wow. Very cool.
It's a lot for earnings season being over. It seems like it's perking up again. All of those, if you own any of them, just keep an eye on them, because they will be more volatile. And if you don't, and you're looking for some options plays, I will be looking every day at what the implied volatility rank of each of these are, and maybe looking at some potential iron condors or strangles on these things. I've also got the existing trades we're going to continue to manage in Las Vegas Sands, DraftKings, and our SPY hedge. And then on 23rd is Dividend Christmas, for me at least, with VXUS, VYM, XLE, XLI, and I believe VDATX may have already paid a dividend, but there's a lot coming up on the 23rd.
Dad.
You just had to mention VDATX every show because I love it.
Yeah. No, I just got a dividend from VDATX, and it's in my HSA, so I get the dividend tax free and use it to buy a prescription or two.
Oh, I love it.
Hey, one thing we do need to make sure is to be aware. So last week we had the witching, the quadruple witching was on Friday, and so just historically, the week following a witching tends to be a downtrend in the market. So just be wise, be aware.
Good. As Greg says, my dividends will be buying more shares for cheap.
There you go.
Love it.
But that's just on the radar.
Oh, man. Well, you also mentioned Stitch Fix, and I don't invest in them, but I do get a box every quarter, so I look a little less crappy.
Your puffy shirt looks great.
Thank you so much. Guys, great show today. Hope you all enjoyed it. Please join us on Money Vikings Premium in our Discord channel to talk with us directly, and have a great week. More to come.
Cheers.
Cheers.